What really separates a small account from a large account beyond the obvious? And in today's video, I'm going to be breaking down exactly what that is. And by the end, it's going to change the way you think about sizing up and scaling your trading. Back when I first started trading with only a couple $100s, and even just a couple of years ago when I recently reset and started trading my own strategy, or my new strategy that I've been trading the past two and a half years, I think about trading completely differently. And what I've learned over the past couple of years in trading smaller accounts to then trading larger accounts, and recently trading with over $200,000 as an account size, I've come to realize it's not what I thought it was going to be. Okay, so let's first start out with the surface level differences. On the surface, it's obvious. Like, you're trading with $1,000 or you're trading with $100 versus $100,000 or $200,000, or the actual number isn't really that relevant. Well, what about my account? I have $726.16. That gets grouped into the smaller account bucket. Now, you can trade with that and trade options or trade with huge leverage, and you can utilize that to trade and make more money, obviously, but that would still kind of classify as a smaller account. But just simply put, if we were to make 1% on a given trade, or we were to risk 1% on a given trade, on a $100 account, right, you're risking $1. And on a $100,000 account, well, now you're risking $1,000, or you're making $1,000. And that's substantially different. I mean, just think about it. If you were to start trading right now and someone told you, well, yeah, you can trade for the next 2 years, you can start with $100, and because of compounding, yeah, you'll compound, and in 20 years, you'll be looking really good. But in the next, year or two, your compound effect, because you're not going to be making too much money, or you're probably going to have to go through a learning curve and you're going to lose. You're not going to make a lot, and you probably won't be really making meaningful money in today's society with inflation, all that stuff, for, let's say, 3-4 years. And a lot of people would see that and look at that and go, okay, well, I'm not doing this. I can't afford to just, do something for 3-4 years and reap no rewards, have to compound the account just to get to a place where maybe I could be in the top X% that are profitable, and then the top X% of that actually make consistent money year over year over year and make meaningful money, not just like break even or just above, like meaningful money that can actually change their life, their day-to-day, and pay for the bills. Yeah, I see where that can be annoying. You're also going to have limitations when it comes to asset classes. When you're on a $100,000 account, you can trade larger asset classes, or you can get into futures, or you can get into things that you might not have had access to, or you can just simply trade with this larger account, and now that 1% move on an underlying stock is substantial versus having to trade with, options to get that leverage to make it substantial, or that 1% move on a given stock making you 26 cents. As you size up, you're also going to get access to margin. So once you start to get over $2,000 into your accounts, especially in the US, at least I know that's in the US, you'll be able to now utilize margin. So they'll usually give you, I think, 2 to 4x margin across most major brokers, meaning that you'll be able to trade with like double the amount of buying power that you have cash into an overnight position. So yeah, now your couple $1,000s can be strung out into more than a couple $1,000. If you've got 5,000, maybe you can take positions that are worth 10 to 15,000 intraday. Or maybe you can take swing trades that are worth $8, $9, $10,000. And now 1% move or a couple percent move on a swing trade on a couple $1,000 or $10,000 becomes a lot more substantial than what it was before you had access to the margin. There's also things like PDT rules, pattern day trade rules. I've made plenty of videos in the past about how to get around them and the many ways you can get around them. But obviously, when you're under $25,000 in a margin account, you can't take more than 3 day trades in a given 5-day span. So that limits you. Now, speaking of platform limitations, with Plus 500, the sponsor of today's video, that is one less thing you have to worry about. Plus 500 offers a very low minimum deposit of $100 and up to $200 in commission-free welcome bonuses. Plus 500 Futures also offers a wide range of contracts to trade, such as gold, Bitcoin, S&P, and a lot more where that comes from. You get real-time market data, 24/5 trading, and super competitive day margins as low as $30 on ETH. Plus 500 even goes above and beyond with 24/7 live support, free webinars, and even their own Futures Academy that offers free education to all experience levels. Top all of this off with the advanced mobile trading options. Plus 500 really does have everything you need to trade futures however you would like. Click the first link in the video description box down below to open your free account. Obviously, trading futures and options does involve the risk of loss, just like a lot of other things, and is not suitable for every investor, and not all applicants will qualify. Part 2, I want to dive into psychology. When you have a small account or a $100 account, you're generally going to be more risk on. A $100,000 account or larger, you can be more risk off. And why is that the case? Well, it kind of goes back to what I talked about before. And in my own experience, back in 2019, I first got started into trading penny stocks. Prior to that, I was trading some options here and there, but I really got into penny stock. I was a senior at Penn State University, and I was at that time $100,000+ in debt, going into even more debt as I was into my senior year. I was more risk on because, again, I'm like, okay, I got this massive debt piling up. I have a couple $100 from a part-time job. Like, who cares? Like, if I lose $300, who cares? And so that's what I did. I started out with a couple $100, and I was like, I don't care. I'll trade penny stocks because they're more volatile. Yeah, there's more risk, but they're more volatile. And if I can make money here, we can make this $300 turn into hopefully thousands of dollars that can maybe make a dent into my loans. And looking back, it could have, but there were mistakes made years later that did not allow that to happen. But that's a story for another day. All that aside, I look at the world now from an investing perspective, and I've even talked to my dad quite a bit about this stuff because, he's someone who's nearing retirement and has built up a portfolio over time in the stock market. And I talked to him about this where he's quite, risk on still. And I'm like, Dad, why are you so risk on? You've made money in your life. You saved a ton of money. You've invested a ton of money. You've got 401ks. You've maxed out the matches. You've maxed out Roth IRAs. Why do you feel the need to be super risk on? Your 10% average market return, if you just rode the average market right now, could provide you a nice income to help kind of kickstart your retirement and not make you feel so worried about money if and when you do decide to retire. Now, this is coming from more of an investing mindset, but the view behind that is as you amass more money, you don't need to take on that additional risk. You'd rather keep that money so that it can keep compounding and keep making you money. And if, I think about it as someone who's 26 years old. Is that how old I am? I'm 20. I'm going to be 27 soon. If I look at the market and I say to myself, okay, I have $100,000 in an investment portfolio and I want to compound this over time, and I can get an average of 10% per year with the market returns, and I can slowly deposit more from the money that I make, and I can just compound this. Why do I have to take on more risk to try to make 15, 20% per year when I could just happily take the market returns or thereabouts and be very, very content with that, let that compound until I'm 50, 60, 70 years old and be sitting on a very nice nest egg? Now, of course, that's assuming the markets over time will continue to go up like they have for the past generations, but that's kind of the approach. Like, you have money. Why are we trying to lose that money that could now make us so much more money, make us, $10,000 a year on a $100,000 account with an average 10% market return that the market's seen over the past 100 years. In my experience, those with the smaller accounts generally have much more of a gambling mentality where they don't look at things from a kind of a strategic, strategy-based, data-driven approach. It's more of like, I need to get my gambling fix, and this is my way to do so, and I have a couple $100 here that I don't really care about, so I can play the game. And if I eventually one day hit it big, that turns my couple hundred into a couple thousand or tens of thousands or $100,000, then I will finally become a lot more risk off. Another emotional component is that you tend to get more attached to the money, especially like as you've been making it or building it for a long period of time. You can get very attached to it, and that could be a good or a bad thing. It means like you could end up saying to yourself, well, I don't want to lose it, and so you'd be more safe, be more conservative, but that can also be used against you to where now your blinders are on, and so you're not open to new opportunities or new things that you maybe were in the past to get you to where you are. And last thing on psychology, there's this pressure, this subtle pressure to make your money work for you at all times. I went through this, I felt this, and I have recently gotten over this. I no longer think about this as the same way anymore at all. Back when I was trading penny stocks, I always felt like if I had any sitting cash, I need to find a place to put this cash. And if you can imagine that situation worked really well when the market was really good, but then it didn't work very well and the market wasn't good and it turned over. So like, obviously, yes, you lose a lot of money if you're always invested in stuff as the market's going down. Yeah, no shit, Sherlock. But it's very easy with today's day and age to always feel like you have to be invested and always you have to be in something else. You have to be trading something. You always have to be in a new swing position. You have to be in day trades. You don't. You absolutely don't. And to be honest, it's those periods when you're not and when you don't have to think about it and nothing is glaring at you on the screen to say, take me, take me, take me. Like, it's totally fine to sit back and chill. But I will tell you, it only gets easier to do that when you have more money, and when you have less, you feel like you're missing out on days, on trades, on weeks and months that you could be compounding a small account. Part 3 is scalability. What worked with a smaller account may not work the same way with a larger account. Back to my penny stock example, the penny stocks that I was trading were pretty low volume. There was not a lot of volume, and so as I had more and more money, I could potentially move some of these stocks up and down with a pretty hefty market buy. If I wanted to go in and I wanted to buy $25,000 of a penny stock, depending upon the float, the shares available to trade, and how much volume it sees, and when I'm making that purchase, is it during market hours? Is it during pre-market hours? Is it during after hours? I could get substantially different fills with substantially different amounts that I'm putting in. So what may have worked with $100 probably won't work with $100,000. This can apply to options. It can apply to other markets as well. There are things like slippage, there's liquidity issues, and then the fills that you ultimately get with your broker. Now, on the plus side, having a larger account will likely get you access to lower margin rates. So if you have an actual strategy that is working, that's making you money, when you have $100 to get access to margin trading, well, you're going to have to pay a percentage per year on the money that you borrow. Now, obviously, you're not borrowing it for a year, you're borrowing it for individual trades, but if you're always in trades and you're always on margin, well, that's going to accumulate some interest. And those couple of dollars on smaller amounts of money will over time add up, and they could eat away with taxes, fees, and commissions into your profits. But as you grow your account gets larger, the broker you're trading on will offer you now lower margin rates, because think about it from their perspective. They're going to make money on the interest that you're going to pay them, but now you're borrowing $10,000, $20,000, $100,000 on margin, and they're happily going to say, yeah, no worries. Borrow it, borrow it, borrow it. We want you to borrow more. We want you to hold swing positions. We want you to hold a lot of money on margin for long periods of time so we can keep charging you interest. Well, in your eyes, if you have a strategy that works and you're making money and you're compounding, you're like, that's a win because I'm going to make more money. To them, that's a win because they're going to make more money off of the money that you're borrowing, and everyone's happy. So as you grow your account, you actually pay less in margin interest, which can help you compound the account even further, even faster, with the exact same trading numbers in terms of win rate, average risk reward as you did earlier. It's just now you have less margin expenses eating away at your profits. Okay, what should you take away? In my honest opinion, risk management matters more the more money you have, but it's built off of the habits that you create with $100. If you create good habits on smaller accounts, as the account grows, or as you have more money to put into your account, or as you reach higher levels of utilizing margin, safely of course, that is going to pay off dramatically down the road. So just because you have a smaller account does not mean you should be more risky. Like, yes, people inevitably are going to be more risky. From my experience, it's not worth it. It's not worth it. Those good habits are so much more worth it later on. And so it's just that delayed gratification of not reaping the benefits of your hard work, of the habits of doing the hard thing early on in the stage that you're going to be so thankful for later on. The more money you have, it does provide you more opportunities and more ways to make more money. But with that, there becomes more traps. You have more opportunities than ever, which could throw you for a loop. It could make you think certain ways that you never thought of before. It can make you trade certain assets that you maybe never traded before and apply a strategy that was working for stocks over to here, or was working for futures over to crypto, and now it's not working, and now you're going downhill. But ultimately, going from $100 to $100,000, the biggest takeaways come from the mindset, the discipline, and the experiences that you have and that you learn and that you are utilizing in that process. The money is not really that big of a deal. It's a byproduct, and it does come, and it can be made 1,000 times over if you have the discipline, the strategy, right, and all the things in place that are going to allow you to compound and make more money down the road. Check out Plus 500 Futures. I'll leave them linked up down below. And if you're looking for a video on trading psychology, I got the best video that I've made on trading psychology right here for you right now. Thanks so much. I'll see you guys in the next one. Peace.